Hey Bowtie Nation, Joseph Hogue here, and after nearly 2 years of outsized returns, stocks are undeniably expensive. This chart shows the current price to earnings ratio of stocks in each sector against the longer term average, with the overall market 27% more expensive than that 10-year average PE ratio. But I don't want to spend any more time on that chart because not all stocks are that expensive. In fact, more than 100 stocks in the market are within 10% of their 52-week lows, and there are some great value stocks out there if you know where to look. In this video, I'll share why every investor needs to be thinking value stocks right now and how to find the cheap stocks with rebound potential. Then I'll reveal the cheapest stocks in each of the 11 stock sectors to help you create a value portfolio for 2022. I want to get to those value stocks, but we can't get started here on the channel without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now first, to understand what we're talking about here, you only have to look at the market lately. After a year of nothing but higher prices, stocks have been through 3 major sell-offs since February, and with 2 corrections of more than 5% just in the last 2 months. Heading into 2022, the stock market is looking scary, and value stocks could be your best bet for return. Not only are these cheap stocks a great strategy for that rebound rally, but if the market does fall apart, they're already in value territory, so not going to fall as much as those expensive growth stocks. I want to get into that list, but I'll show you how I found these later in the video. And our first stock, the cheapest in the technology sector, is TD SYNNEX Corporation, ticker SNX, at just 0.21 times revenue. Now, TD SYNNEX provides business peripheral services in IT and technology, a lot of ways to help businesses become more productive. I think this is going to be such an important theme over the next couple of years in this great resignation. As you know, it's so hard to find workers. Businesses are going to be looking for ways to do more with less, to become more productive with less workers. So let's just take a look at some of the fundamentals, show you how I analyze a stock and the statistics behind this company. So we'll go here to statistics, and the first thing we'll start off with, since this is a cheapest stocks by sector, is we'll look at the valuation. Now you can see here the trailing PE is under 10, always a good sign. It's 9.5 times. And again, a lot of these, you're going to want to double check them just to see, if Yahoo Finance is measuring that right and where it's getting those from. But we'll go on. Price to sales is 0.21 times. So basically you're paying just 21 cents a share for every dollar in sales that this company collects every year. That's a great place to start. Another one I like to use here is the enterprise value to revenue valuation. And this goes back to my days in venture capital. Anytime you're doing kind of M&A analysis, so merger and acquisition analysis that focused with whether you want to buy a company outright with that acquisition or a merger, you would look at this enterprise to revenue basis. Okay, and what this is the market cap of a company. So you see here the total shares, total shareholder value, right? All the shares out in the market is worth 10.46 billion. Now to get that enterprise value, what you do, you go down here to the balance sheet and you take off the cash. Okay, and then you add in the debt. Okay, and we can see here that TD SYNNEX has total cash of $4.05 billion and total debt of just $4.18 billion. So actually really close to the same. So if we get out our trusty calculator here and we come back up here, we find that 10.46 billion is the total market value of this company. What investors are paying for all the shares, it's 10.46 billion. And now we minus the cash, minus 4.05 billion, and then add back debt, 4.18 billion. We get an enterprise value of $10.59 billion. Okay, and what this is if another company were to come in and buy this company to acquire it, then it would have to pay that market value, right? I would probably have to pay a little bit more, but we start with the market value of the shares, but it would get all this cash in the deal. It would get $4.05 billion in cash. So we take that off of that market value, right? That would be like a discount to what it paid for the market value of those shares. But it then would be responsible for paying this debt, this $4.18 billion. So you want to add back that debt. So that's why we took that $10.46 billion market value, that market cap, minus the $4.05 billion in cash, plus back the total debt of 4.18 billion, and we got that number of 10.59 billion. Now that, again, that is the enterprise value. And if you take that enterprise value to revenue, you see it's an enterprise value to revenue ratio of 0.39. And again, that's just another way to value a company. A little bit more important for mergers and acquisitions analysis and some of those other types, but also a strong way to analyze the value of a company. We'll look at another couple of the statistics that I always use here, the operating margin and return on equity. So first, the operating margin is, again, that's going to be your operating profits divided by sales, and that's going to be on your income statement. And that, all you out there in the nation know, this is my favorite ratio to use, my favorite measure of performance for a stock, because that is the core operating profitability. That is how well management is doing at a core level of the business in turning those sales into operating profits. Okay, so you're going to see this number on Yahoo Finance calculated out for you. It's important you know how to calculate it yourself just to double check these numbers. So again, that's going to be on the income statement, and we can even go up here and show you how to do this. In the financials, you'll see the income statement, and first you're going to see total revenue. That's always the top line. And then if you come down here, you're going to see operating income. That's after cost of revenue. So that's after the company has paid all its suppliers, production costs. That's after operating expenses. So what are your marketing expenses? What are staffing, administration expenses? And you're going to be left with this operating income. So if you take the operating income divided by total revenue, that gives you that operating margin. Again, a very important statistic to find how well management is doing, turning those sales into operating profits. Next here is the return on equity. And this is just another measure of management effectiveness, right? What income is management being able to, to produce divided by shareholders' equity. So it's a core measure of the efficiency or the effectiveness of management at turning your investment dollars, your shareholders' equity, into profits. Okay. And again, this is the net income divided by shareholders' equity. I'll show you how to find this real quick. We won't do this for every stock in the list. I just want to get you started and let you know exactly what I'm looking for in these. So if we want that net income, that's on the income statement, and that's going to be the bottom line earnings. You're always going to look for net income available to common stockholders. And for TD SYNNEX, that was $485 million. These are in thousands. So $485 million. And then for that shareholders' equity, you go to the balance sheet. Now, what shareholders' equity is, it's all the assets of the company. So everything the company owns minus what it owes, minus all its total liabilities. Okay, so assets minus liabilities is going to equal your stock equity, everything that investors own in that company. So if we get that net income available to stockholders divided by this common stock equity, or usually it's called shareholders' equity, you're going to get that return on equity measure. Okay. And again, just a very important measure of how effective management is at turning that shareholders' equity, your investment in the company, into income. Just a couple more things I like to look for on the stocks, and then we'll get to our next stock, in the cheapest in the communication services sector. But here, I want to look at the revenue growth, okay? Because we're not just looking for cheap stocks. We want to find stocks that are actually able to grow their sales. Now here it says TD SYNNEX hasn't done so well on that measure. It's actually lost 1.9% on a quarterly basis year over year. So in the last quarter, it reported sales that were 1.9% below the same period a year ago. That's not a good sign. So what I would want to do, I would want to double check that. Go up here to the financials, and that's sales. So that total revenue, that first line of the income statement, and I would want to check this out. Okay, so whereas I do see that they did have some weakness probably in 2020 because of that pandemic, because of the business spending. It has grown its sales over the last 3 or 4 years. Okay, so it had sales of $20 billion here in 2018, and has grown that to $26.8 billion here in this last 12 months. So even though sales growth was a little bit weak here in this last quarter, it's still done well over the last few years. So that's a good sign. Next here, I want to look at the balance sheet. And again, this is something that we looked at earlier with that enterprise value, but I always want to check just to make sure that the company doesn't have just too much debt, right? A lot of companies have gotten into trouble, AT&T, GE, a lot of those bellwether companies that were always safe stocks have gotten into so much trouble just because they put on too much debt. So you always want to check out to see how much cash a company has, how much debt it has, and this debt to equity ratio is always an important one. And since this company has, just about the same amount of cash as it has in debt, it's pretty much cash covered on its debt. So definitely not a worry with this. Last thing we'll look at for TD SYNNEX, and then we'll move on here. But I want to check out the price estimate, the 1-year target estimate from analysts. And so Yahoo surveys the analysts covering this stock and says that the average 1-year target estimate for the shares is $139.63. So with shares at $111 right now, that's about a 30% upside, a little less than a 30% upside to that 1-year target estimate. So definitely checks that box. Next here in the communication services sector, we have Thrive Holdings, ticker THRY, at a share price of 1.18 times its revenue. Now I'll show you how I found these stocks in a minute, but I wanted to get in kind of a disclaimer here because we aren't just looking for the cheapest stocks in each sector without looking at those fundamentals as well. For example, when I did my search, Thrive was actually only the 4th cheapest stock in that sector, behind IDT Corporation and Clear Channel Outdoors. Looking through those though, because of the debt or revenue growth or other factors, I just couldn't recommend them. So use that cheap stock screener that I'm going to show you as a starting point, but then use the rest of the analysis that I've shown you here on the channel to find those value stocks with that strong upside potential. So obviously a little bit more expensive than the first stock we saw, but in communication services, you're going to pay more for those faster growing stocks. Now, Thrive actually produces or provides internet marketing and cloud-based services for small and medium-sized companies. So definitely 2 very necessary products and in a niche that I think it can dominate. A lot of the larger companies are going to provide those marketing services or the cloud-based services, but only for the very large enterprise customers. Very much fewer companies focus on that small to mid-sized segment. So I think Thrive Holdings has a great niche here and can really dominate that space. But let's look at some of these statistics here, and we won't go in quite as much detail as we did in the last one. But if we just look at these valuation measures, so the trailing price to earnings ratio, just 6.3 times, which is very low. If you look at the overall market, the S&P 500, trading at right around 20 to 25 times on a price to earnings basis. So this is trading very much in value territory compared to the rest of the market. That price to sales, as we said, about 1.2 times, and then price enterprise value is 1.68. Of course, that means it does have a little bit more debt. The enterprise value is higher than the market cap, and we can go down there and look at the balance sheet. Now it says it has 10.37, so 10.4 million in cash and 612 million in debt. So that's quite a bit more debt than its cash covered. But what you'll notice is a lot of these very large companies, a lot of these large, stable, cash flowing companies, that isn't quite so much the problem because they are cash flow. They do have positive cash flow. They are cash generating machines. And so they're able to cover that debt. They can take on more risk, more debt, and really lever up those returns. Now I want to look at the operating margin and the ROE. Operating margin of 20.7% and a return on equity. This is amazing. 121% return on equity. That is very strong. What it means is it is producing a net income of 121 times what the shareholders' equity is right now, which is very high, obviously. And again, what you would want to do with a lot of these is not just look for the highest ones you can find, but check these against competitors in their field. So I would want to look for others in the technology space, in the communication services sector, and even within its own industry, and look at what their operating margin is, look at what their return on equity is, and to really find the companies with the management that's really being able to produce these higher operating margins and these higher return on equities. Now, as far as revenue growth here, this last one will go 24%. So last quarter, it produced 24% revenue growth on a year-over-year basis. Very strong revenue growth there. So I would actually wonder why this stock is trading so cheaply. So we're not just going on the cheapest stocks in the sector. You do need to do some kind of fundamental analysis and some background on these companies to see why they're trading so cheaply in the market. And now we're not just looking for these cheap stocks just for the sake of being cheap. Historically, value stocks have beaten those more expensive growth stocks. You see here the portfolio value of $1 invested in value or growth since 1927. And that outperformance in value stocks has grown for decades. And to be sure, while growth stocks have done better over the last few years, we're getting late in this bull market, and that's when you're going to start seeing these value stocks reassert that leadership. Over the next few years, as the economy slows, it's going to be the value stocks that outperform once again. Our cheapest stock in the real estate sector is Jones Lang LaSalle, ticker JLL, at a price of 0.74 times its annual revenue. Now, Jones Lang LaSalle, I actually almost worked for him when I was coming out of college. I had worked in commercial real estate and was going to be an analyst for him before I took another job. But Jones Lang LaSalle is mostly in the office space. They provide business management and property management services for a lot of office space. So that's probably why this stock is cheap, because after the pandemic or during the pandemic, we're seeing a very much a slowdown in those return to work, return to the office space plans, and a lot of these office space REITs, these real estate investment trusts, are being hit by that. Now, actually, I think this could be one of the big surprise stories of 2022 and beyond, is how quickly we do bring people back to the offices and how well office space actually does. As a work from home freelancer and worker since 2013, I can tell you there will always be a need for office space. I rent an office space myself every once in a while just to get back into the office and get back into that formal setting. And I know I think office space is going to do better than what a lot of people are actually thinking. But we can look into some of these statistics here, and with REITs, with real estate investment trusts, you always got to understand that you can't use some of these older or some of these traditional valuation metrics, right? You really can't use the price to earnings ratio. And I'll tell you why. With these REITs, these real estate investment trusts, they own so much real estate, and they take billions of dollars or hundreds of millions of depreciation off their income every single quarter as a tax expense, right? They take that depreciation of the real estate off their earnings to avoid paying those taxes. But it's not a cash expense. That is not actually cash they have to pay. So the earnings are distorted here. They are not a true sign of the cash generating power of this business. Now, you can still use the price to sales ratio because those sales aren't distorted by the depreciation they have on the income statement. Sales, or that total revenue, that is the top line of the income statement. It's just reported as a number without anything coming out of it. So we'll use this price to sales ratio of 0.74 times. The enterprise to revenue, enterprise value to revenue is still also a good statistics because it's just the market cap. So the total value of all those shares trading in the market minus cash and then adding back debt. So again, 0.91 times. And what I like to look for in these enterprise value to revenue measures is, could somebody acquire that company for less than the annual sales? And you can see here at 0.91, someone could actually come in, buy this company for less than the annual sales that it is booking right now. That would be a pretty darn good deal and could actually make it a takeover target sometime in the future. But we'll look at some of these other statistics. We'll look at that operating margin and the return on equity. Now, operating margin of 10.21% is actually a little low, probably not too low compared to a lot of office REITs right now. A lot of these, they obviously have operating expenses that haven't come down. They still have to pay their staff. They still have to pay administration and things like that. And yet their revenue has come down during the pandemic. So 10.21%, a little bit low, but I would suspect that would come up here in the next couple of years. Return on equity, 14%, is actually really good for a real estate company to be able to produce that net income of 14%. But again, using the net income base or the net income and these net income ratios, you really have to use cash flow with these. So I wouldn't put too much on this return on equity. I would look at the revenue growth. And quarterly revenue growth, 34%. So obviously a very good quarter for Jones Lang LaSalle last quarter, booked 34% year-over-year revenue growth, and that really shows you the return to some of these, to strength in these office spaces. So I really like this company, and we'll just look at the 1 year price target, $335 per share. Okay, $335 per share is the average 1 year target estimate by analysts. If you take that over the current $260 stock price, that's $70 more. That's that is a potential return of 27%. Okay, and now they did probably suspend their dividend. They're not paying a dividend right now. We can go to this historical data tab, check down here, change this time frame to 5 years, and dividends, show dividends, and we'll do that. Okay, so we see that they did suspend their dividend in November they suspended it before the May payment in 2020. Obviously, because they were protecting cash flow during the pandemic. So what I would suspect is here into 2022, as they start seeing that cash flow build, as they start seeing more certainty around the return to office and their revenue, they reinstate this dividend, and I think that takes these shares very much higher. Okay, if they just take it back to even 35 cents a share where it was in 2017. 35 cents a share on a quarterly basis, that would be $1.40 a share. So it wouldn't be a super high, it wouldn't be a very high dividend yield, 260. So it's only 0.5% dividend yield, but I think the signal that it would send to the market by reinstating that dividend or any kind of a dividend would be a strong signal and would take this stock higher. And we're just getting started, but I want to get your input on this as well. Growth stocks have been the only game in town for the last few years with those double and triple digit returns. Now, if the market does weaken in 2022, cheap stocks and that value theme should outperform, but which do you think is going to be the better investment? Scroll down and let me know in the comments which strategy is going to win out in 2022, growth or value investing. Back to our list though, and in the industrial sector, the cheapest stock is Fluor Corporation, ticker FLR, at a price of 0.24 times sales. Now, I really like this one. It's providing engineering, construction, and management in those engineering and construction spaces throughout the world. It's a very large, it's a $3.5 billion company. So it's one of the larger ones in engineering and construction. And of course, we just signed that massive $1.2 trillion infrastructure bill here in the United States. That's going to start getting paid out to these engineering, to these construction companies over the next few years. And I think that's going to be an upside catalyst for companies like this, especially Fluor, which is one of the best of the breed. So let's look at the statistics here. Let's look at some of the valuation measures here. Now, it doesn't have a trailing price to earnings basis because it's probably not making money right now. And to double check that, we can always go back here to the page and we can look at the earnings. So they've only got 2 quarters of earnings here. I would wonder why they don't have all 4 quarter earnings. We can look at here at analysis, and that's going to give us our average estimates from analysts of the earnings that analysts think that the company is going to produce over this year and the next year. So analysts think that it's going to produce 81 cents a share in earnings this year on 11.08, so $11.1 billion. Okay, so we'll just use those numbers instead of what they're telling us because obviously they're not bringing in all these. So 81 cents a share. If we go here, we can do 24.63 divided by 81 cents a share. So it's trading at 30.4 times on a price to earnings basis. So that's actually pretty high. That's actually really expensive for a construction company, for an engineering firm. On a price to sales basis though, let's look at this, 11.1 billion, and the market cap, which is the total value of all the shares, that is going to be 3.5 billion divided by 11.1 billion. So that's only 0.31 times on a price to sales basis. And what I think is happening here is the sale or the earnings are so artificially low because of the pandemic and that kind of thing, that it's really trading at that premium on a price to earnings basis. But price to sales is a much better, a much purer measure here that we're going to use. And we can also use the enterprise value to revenue, again, 0.17 times. So this is trading at deep value territory. We look at the balance sheet here, and it's got almost $2.2 billion in cash on the balance sheet, okay, against just $1.2 billion in debt. Okay, so this company that is a $3.5 billion company, total value of all the shares outstanding, has $1 billion beyond its debt, $1 billion in cash. Okay, so that means about a third of the stock market value of this company is just in cash, is cash secured. So that's a great place to start on those. Let's look at some of these others here. The operating margin. Operating margin 0.75%. So that is extremely low. It means, and that's probably why it's not showing much in earnings just yet, because it's it's eating up a lot of those sales in its operating expenses and cost of goods sold. So we would want to look at that. Obviously, return on equity. If net income is going to be zero or negative, then this return on equity is going to be negative as well. So again, what we would want to do here is we would want to compare this against other construction and engineering firms, just to see how they're doing. If they're doing so much better than Fluor, then we would want to make maybe take a second chance at some of these other stocks instead of this one. But because of how the market is playing out, I think these are actually decent numbers, and I can keep on looking. Now, quarterly revenue growth is negative here. So again, we would want to kind of check that out on the financials tab here, look at the income statement. And what we can see is that sales have been trending down. Sales have been trending down since 2017, from $19.5 billion down to just $14 billion over the last 12 months. So I'd want to check into that, see why sales have been trending down so much lower. But I do think that this one is going to get that positive catalyst from the infrastructure bill, and is going to improve those sales and improve its earnings picture. Our value stock in the utilities sector is Vistra Corporation, ticker VST, at 0.90 times on a price to sales basis. Now, Vistra is a fairly large utilities company that services 4.5 million residential customers in 20 states, mostly in the south and southeast region of the United States. It does pay a dividend, so 2.75% dividend, and we can check out the valuation measures here. Now, the trailing PE, again, it says it's negative earnings. So what we would want to do here again is see if we can check out. Okay, so we do see that earnings have been negative, and they have missed earnings expectations over the four of the past 4 quarters. Every quarter they've missed earnings expectations. So that is a warning sign. Analysts were expecting $1.13 earnings reported over in the last quarter, and they actually had reported just 1 cent in earnings. So we would want to see, why Vistra is missing those earnings expectations. That's obviously why this stock is so cheap, because it has produced negative earnings in the past year and has missed those earnings expectations. So we want to go through here. We want to look at some of the other statistics. On a price to sales basis, that's 0.9 times. On an enterprise value to revenue, 1.9 times. Now that's because it has so much debt. And we can look here. We look at the market cap is $10.14 billion. And if we come down here to the balance sheet, we see it only has $370 million in cash against almost $12 billion in debt. Now, obviously, for a utilities companies are going to carry much more debt. They have a monopoly on their regions. They have a regulated monopoly on their regions, so they know their cash flow. They're going to book their cash flow, and they know pretty much how much that is. So it's very much a stable cash flowing business, and they can afford that risk in the debt because they know they're going to be able to cover that debt. But still, like a little bit much on the $10 billion in debt. Operating margin is negative 20%, so it is not even creating positive operating profits here. So we would definitely want to look back in here. Again, we're not just going for the cheapest stocks in these sectors. We do want to do some analysis on these and make sure that they're the best stock for that price in the sector. Now we can go up to the summary, and see what analysts are thinking about it. And even on those negative fundamentals, analysts still expect a $27 share price target within a year. So $27 per share over $22 current price. That would be roughly about a 20% return if it could meet that 1-year target estimate. We're using fundamental analysis to find our cheap stocks, but another way I love to look for stocks to buy is through technical analysis, looking for the trends and the buy signals in stocks. It's exactly the kind of strategy I put together with Thomas Carvo in a workshop on stock trading and technical analysis. It's 35 videos and more than 4 hours of instruction on the stock signals you need to know about. You'll learn everything from trading timeframes to using stocks charts and finding the trends that are going to send stocks higher. You'll be able to download a trade journal template along with a trade cheat sheet and lots of other bonus material. And we just launched the workshop a couple of months ago and are offering a special 35% discount, more than $150 off to everyone out there in the community. So check out the link I'll leave in the description below. Our value stock in healthcare is going to be Facilities Operator Community Health Systems, ticker CYH, at a price of just 0.13 times sales. Now, these healthcare facilities operators, so these companies that manage and lease the hospitals, have been hit really hard during the pandemic. Okay, a lot of them, they're in crisis mode, just serving those COVID patients. They've had to dial back, they've had to postpone or even cancel a lot of these higher profit margin services, like the elective surgeries, like the plastic surgeries that go on there. So they're in crisis mode. They're only serving those COVID patients, and that's really hit the bottom line. Okay, their sales are lower, their revenue is lower, their earnings are lower, and they still have all these expenses. So a lot of these are in deep value territory, but I think that's going to change. Obviously, once we move beyond the pandemic, all these elective procedures that were postponed or eliminated during the pandemic, those are going to come back, and you're going to see just a wave of revenue coming back into these hospitals, into these facilities. We're not getting any younger. The aging demographics of the United States and really of the world means these healthcare facilities are really in a sweet spot for services and some of these procedures. So we're going to look here at the statistics. Check out these, it still does have positive earnings, so that's good, and is trading at just 4.2 times on a price to earnings basis, which obviously is extremely low. Anything under 10 is that classic Warren Buffett, under 10 price to earnings ratio basis, and here it's under 5. It's under 4.2 times on a trailing price to earnings basis. Price to sales, again, just 0.13 times, and even an enterprise value to revenue. So it does have quite a bit of debt on the balance sheet, and we'll look at that in a minute. But even on an enterprise value to revenue basis, it is still trading at 1.07 times. So deep value territory for this one. We can look at the operating margin, 9.6%, which is fairly good for hospital facilities, especially given the very, very tough environment they're operating in right now. Revenue growth was negative in the last quarter, so we can go up here and check that out. We can look at the total revenue over the last several years has been trending down, $15.3 billion in 2017. And even before the pandemic, we can see it was trending down to $13.2 billion in 2019, and has fallen another $1 billion here in the last 12 months. So $12.2 billion in revenue. Again, I suspect that will improve here over this next couple of years as we start getting to more of a sense of normal with these healthcare facilities, with these procedures. But we can go back and we can check out the balance sheet. Again, it's got $1.3 billion in cash. And so for a company this size, for a company of $1.68 billion, it still has a very good cash reserve. Okay, so even if all those elective procedures don't come immediately back, it's still got a pretty good cash reserve to hold it over. It does have $12.7 billion in debt on the balance sheet. So that is obviously why this stock is trading for so cheaply, because it does have so much debt. So it does need to have those elective procedures coming back, but it does have positive operating cash flow. This operating cash flow, that is the core cash generating power of the business. It's cash flows from operations. That is positive 500 million in the past year. So it is producing those positive cash flows. The cheapest stock in the energy sector is one of the cheapest on our list, PBF Energy, ticker PBF, a price of just 0.07 times sales. Now, PBF Energy is in the refining and marketing space within the energy sector. So this is a company that takes that oil, takes the natural gas and other feedstocks, and it turns it into gasoline. It turns it into fuel and other things. And so what you got to understand is the margin on this part of the business has been hit over the last year, but I think it will come back. I think it is on its way to rebound, and it's got some great distribution services as well, which anything in logistics is trading at a premium right now. So I think that's why this is in value territory, but could be ready for a rebound. We check out the statistics here, and we can see that it's got an NA here for the trailing PE, so we'd want to look at to see where it's got for the earnings, and we can see that it has posted negative earnings here in these last 4 quarters, though it has beaten expectations, which is a good sign. Even if a company is unprofitable on that net income basis, that it is beating earnings expectations. And you can see the trend here. It has come all the way from the last quarter of 2020 to reporting a negative $4.53 in earnings, all the way up here into the most recent quarter, actually a positive earnings of 12 cents a share. So that trend is definitely a positive sign. I think they're going to report positive earnings here in 2022, and this stock could be ready for a rebound. Even though negative earnings are negative, it's trading at just 0.07 times on a price to sales basis, and on that enterprise basis, just 0.323 times. So a company could come in, acquire this company for less than a fourth of the sales that it books every year. Now, of course, a big part of that reasoning for that valuation, for that steep valuation discount, is not only the negative earnings that it's reporting right now, but also this debt. It is a $1.5 billion company, $1.5 billion market cap, but it has, it's a $5.2 billion enterprise value, which means it has a lot of debt. We can go down here to the balance sheet. It does have $1.5 billion in cash, so plenty of cash reserves to hold it over until that refining and marketing business comes back. But it does have $5 billion in debt. So a lot of debt, but still enough cash, I think, to see it through what is arguably a bad time for refiners and the whole industry. You can see the operating margin is negative 3.9%. Return on equity is negative since it is negative earnings. So it is coming out of a tough spot. But you can see the quarterly revenue growth, 96%. In the last quarter, the most recent quarter, it reported revenue growth, sales growth of 96% over the year before. So what we're seeing here, like we saw with that earnings, is that trend higher and sharply higher with this 96% revenue growth. I think 2022 could be a very good year for the refiners in general and for this PBF Energy. We've still got 3 of the cheapest stocks with some great rebound potential, but I wanted to show you how I found these and give you some ideas to narrow your value stocks list. I'll be using the stock screener on Yahoo Finance just because it's free and available to anyone, but you can do this on any investing app. Now I'm first going to filter only for mid-sized companies and larger, so no penny stocks in this list. All you out there in the Bowtie Nation know we love us some penny stocks here on the channel, but for this list, I want to narrow it to those with the size to survive whatever happens in the market. Next, we'll filter for stocks in each sector. So we'll toggle for the stocks in the basic materials sector here and then repeat that screener for each of these sectors to find the cheapest stocks in each. I can add another filter here and scroll down to these valuation measures like the price to earnings and price to sales ratios. Here, I'll be using the price to sales ratio to measure our value stocks because it's more of a pure measurement than we get with that PE ratio. So we'll start by filtering for stocks trading at a price to sales ratio of less than 1. Stocks trading for a price of less than 1 times its annual sales. And that still leaves us with almost 100 companies. So we're going to decrease it further to 0.5 times sales. That's still 32 stocks. So let's try 0.3 times sales, and that just gives us 9 stocks in the sector. Now I can click through here and check out the price to earnings and the price to sales for each of these, and then dig a little bit deeper to find the ones with the lowest price multiple. Then what you want to do, you want to just use some of that fundamental analysis that we use here on the channel to narrow your list of cheap stocks or just go with the cheapest stock on that price to sales basis like we're doing with this list. Our value stock in the financial sector is the cheapest in the group at just 0.03 times on a price to sales basis. StoneX Group, ticker SNEX. And now this is a really interesting company that provides capital market and OTC services for large and medium-sized companies. So they're going to handle a lot of the trading, a lot of the administration and bookkeeping for those services. Very interesting kind of picks and shovels kind of idea to the capital markets and to financial services. Now, this is a smaller company. It's just $1.2 billion market cap. It isn't quite as heavily traded as most of our stocks. It only has an average trading volume of 70,000 shares, but it is large enough that I don't think it's going to be manipulated by any kind of boiler room kind of pump and dump schemes, because it is just such a large company. So we can look here at the valuation statistics, and it is trading for a 10.4 times on a trailing PE basis. So a little bit higher than that typical 10 times PE ratio, but I think that's just because earnings are depressed momentarily coming out of the pandemic. If you do look at sales, price to sales of just 0.03 times sales, and that has a lot to do with the enterprise value, the debt that the company is carrying. It's a market cap of $1.2 billion, and it has $12 billion in balance sheet cash. So actually a ton of cash on the balance sheet here. And debt of $7.7 billion. So actually, I think there's something wrong here, because if it's $12 billion cash minus the $7.7 billion in debt, it would have a lower equity or enterprise value. It would actually have a negative enterprise value. So this is wrong. So this is just a reason why you always want to check these numbers. Okay, so what we're going to do, we're going to go to the actual balance sheet of the company. It's usually posted here. So we'll go to financials and we'll go to balance sheet. Okay, so now on the balance sheet, we can see we go to total assets, current assets, and cash equivalents. So there's $1.1 billion in cash. And now we can go to find the debt. We'll go to this total liabilities, and we'll go to non-current liabilities for that debt, and long-term debt and capital. Okay, so here we see this is different. It for some reason Yahoo Finance miswrote those numbers. So cash is actually $1.1 billion. Debt is $7.4 billion. So we can go back here to the statistics and check that out. So cash, so it did have total debt was about right. It was 7.4 billion. They've got 7.7 billion here, but now the cash, it looks like they just put the decimal place in the wrong spot here. So it's actually $1.1 billion in cash, $7.4 billion in debt. So it's about $6 billion in net debt here. Now that $1.2 billion in cash, again, like a lot of these companies that have a lot of debt, it's still got a very good cash holdings, cash reserves to see it through any kind of current weakness it's going through. So this doesn't quite worry me quite as much, but it is a reason why it's trading in value territory, because it does have $7.4 billion in debt. If you look at the operating, the cash flow statistics, though, $2.1 billion operating cash flow, that is still a cash generating machine, right? It's still a cash flowing company. So it should have no trouble paying off that debt and keeping up with that debt. We can go to some of these other measures here. The operating margin is extremely low at just 0.38%. So I would want to check that against other capital markets companies to see what their operating margin is and really compare this company against those. Now, if we look at the 1-year target estimate here, $78 with a $60 current stock price. So that is a very strong potential return. It's over 25%. If we go 18 divided by 60, that's a 30% potential return actually to this average 1-year target estimate by analysts, $78 per share over the $60 current. So that is a strong vote of confidence from the analyst community. The cheapest stock in consumer staples is going to be United Natural Foods, ticker UNFI, at a price of just 0.12 times revenue. Now, UNFI is a distributor of foods in both the retail and wholesale market, which obviously has been hit over the past year on those inflation worries. Okay, a lot of the company's costs, those distribution costs through its truck drivers, through its wages, as well as just those food costs are going up. It's not quite able to pass on all of those costs onto its customers, so it's seeing its margins, it's seeing its profitability come down, and that's why a lot of these stocks in food distribution are hurting here. We can take a look at the statistics though, and it is still posting positive earnings, so that's always a good sign. Trailing PE of 22 times price to earnings ratio, which is typical of these consumer staples companies. Typically in the consumer staples sector, you see those higher price to earnings ratio. Investors are willing to pay a higher price for those earnings of those companies because they're stable, growing companies that do pay a dividend. On a price to sales basis of just 0.12 times though, and a enterprise value to revenue of just 0.24 times, definitely in the value territory for this stock. We can go to the balance sheet. It's got $46 million in cash, so maybe a little low on the cash reserve side. Total debt of $3.72 billion, but it is a positive cash flow company. It's an operating cash flow of almost $600 million a year, as well as levered free cash flow. So free cash flow available to to return to shareholders or whatever the company wants to do of $400 million. So this low cash reserves wouldn't worry me because it is a very strong cash generating company. We can look at some of these others. The operating margin of 2%, pretty typical of these consumer staples companies. Very low profitability, very low margins. 2% here for this one. 16.5% return on equity, which is obviously because it is very highly leveraged with a lot of debt. We can see that the revenue growth is 4.7%. Again, typical of these consumer staples companies that in very competitive environments, very slow growth environments, any kind of food distribution, grocers, they're not these kind of growth stocks that you see in tech or communication services. It is very much a 3 to 5% revenue growth per year kind of business. If we look up here at the target estimate, we can see it's a $54 per share 1 year target estimate. That's about $6 above the $48 share price currently, which is 12.5%. 12.5% potential return to that 1 year target estimate. So a little bit slower or a little bit lower than some of our other stocks that we've seen to that 1 year target estimate. But I would suspect that this dividend and the dividend yield is coming back sometime in 2022, maybe next year. And that's going to be a positive catalyst for these shares as well. In the consumer discretionary sector, the cheapest stock is going to be ODP Corporation, ticker ODP, at a 0.23 times on that price to sales basis. Now, ODP is kind of a weird company here because it does compete in that retail industry within the consumer discretionary sector, but it competes in different parts of this industry. It provides business supply services, so office supplies, as well as other business supplies, which has obviously been a very weak segment of retail over the past year. Obviously, with retail spending getting hit by the pandemic, they're pulling back on those supplies that they need. But ODP also competes in a workplace technology segment where it's helping those small and medium-sized retailers become more productive, which again, like we talked about before, I think is going to be a very important segment of the market, helping companies become more productive, do more with less workers over this next couple of years. So we can look here at the statistics. And we can see that it is trading for under 10 times on that trailing PE basis, on that price to earnings basis. So that's always a good sign. Price to sales is 0.23 times. It does have a little bit higher. It does have some debt. So the enterprise value to revenue is a little bit higher, but still at 0.25 times. So a company can come in, acquire this company for a quarter of its annual sales, which is always something you like to look for when you're doing M&A analysis, mergers and acquisitions. We can look at that balance sheet. It's got $753 million in cash on the balance sheet set aside to handle whatever the economy brings it, against $1.13 billion in debt. So actually, that's not a bad position. It's got $1.13 billion in debt, $753 million in cash. So it's only a net debt of about about $350 million, which isn't bad. It's positive operating cash flow, so it is making money. Levered free cash flow is negative, so it is not making enough to cover some of its capital expenditures and those R&D and that kind of expenses, but it is operating cash flow positive. We'll come back up here to operating margin, 3.3%. So that is a little bit low. We would want to check that against other competitors in its space, others in the industry. The revenue growth here, negative 7.2%. So that would be worrying. So that we would want to, again, go up here to financials, look at the income statement and see where that revenue has gone. So we can see in 2017, it was $10.2 billion. It actually did trend. It went up to 11 billion, then down to 10.6. So before the pandemic, it was doing fairly well, from $10.2 billion to 10.6. It took a big hit over the last couple of years during the pandemic, but it is now up to $9.3 billion. And again, I think this is something that can rebound along with retail and along with that consumer spending, consumer spending category. If we look here at the one-year target estimates, $59 a share against $38 a share current price. So that is probably going to be the best potential return of the group. 59 divided by 38 here, that is a potential 55% higher to the average analyst price target. Click on the video to the right for the 7 monthly dividend stocks that will pay your rent. 7 stocks for cash flow every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.